I wouldn't say I was super bearish, but I think that that there are headwinds at the moment, and I do worry particularly about the US market, where I think valuations are still stretched. And also, funnily enough, across regions, the US is the place where you can see that earnings per share are starting to trend downwards. There are other places in the world that I quite like, emerging markets, Chinese equities I think are a good value. So it's a mixed picture, but the US dominates, and I think the US market is still stretched.
And I appreciate that. I can't put you into a binary 0 or 1 camp as well. And yet you are quite binary on some interesting assets like commodities, expensive and cyclicals. Now, despite what you just said to us about your interest in China and your hopes there, reducing commodities to 0 in terms of holding, that is quite, dare I say it, bearish economically.
Yeah, well, again, it comes down to pricing, and it also, I think the global economy is decelerating. So I don't think we're in a great economic phase for commodities, particularly industrial commodities. But if you look at the pricing of energy, for example, natural gas prices in Europe, I think, are still abnormally high. Right. After Russia's invasion of Ukraine. They've come down a lot, but I think they're going to continue normalizing this year. And through a process of arbitrage, I think that will dampen other energy prices. So it's partly pricing, partly economic cycle.
Just to finish on that, so you think the gas normalizing will lead to oil prices going down?
Yeah, I think there's a natural process of arbitrage here. We saw the reverse of that last year when natural gas prices go up. Where people can substitute from one to the other, they naturally do that. If one price goes up a lot, they will switch to the other to the extent that they can. And I think on the way down that will happen as well. And by the way, the oil price at $70, $80 is not cheap. It is above what I would consider to be its normal level.
Paul, Chinese equities remain one of your best-in-class assets on a 12-month projected return basis. How does that fit in with the narrative of this slowing growth that you're telling us this morning? Because you'd expect China also to be synced into that global economic story, or China in particular, because it's the manufacturer of so much of what the rest of the world consumes. Is this a valuation argument, or why do you like China?
Well, it's a bit of both. I think if you, I look at cyclically adjusted PE ratios, and China is still very much at the lower end of its historical range, whereas somewhere like the US or India are well above their historical averages. So it's partly that, but it's also, I think there is an element of desynchronization going on here. China was effectively in recession last year and is coming out of that, partly as a result of the elimination of the zero COVID policy, but also the central bank in China was easing last year when most central banks were tightening. So the monetary momentum in China is a lot better. So yes, China's economy will do better when the world is doing better, but I think that nonetheless the Chinese economic situation can improve versus where it was, whilst it is deteriorating in places like the US and Europe.